extra $1 to $5 million would have been good to lock up. Okay. So adding to these headwinds, I think we've been talking about the possibility of a recession for those new to the concept of a recession. If you're under the age of 30 and haven't really lived through one as an adult, it's 2 quarters, the official definition, 2 quarters of negative growth of the GDP. Well, it turns out US GDP fell 1.4% in Q1. And Q4, we had a 6.9% growth rate. Q1 was the weakest since the spring of 2020 when COVID hit.
Nick, cue the clip where Sacks and I basically said this may happen in January of this year.
So the concern is that, with the losses we're seeing, and I mean, every day I keep seeing more red, that this could turn into a recession. Popping of bubbles is usually followed by a recession. So I think, the fortunes of the economy could turn really quickly here. And
that is the marginal risk. The marginal risk is actually for a recession. David is saying something really important. The risk, in my opinion, is not of runaway inflation anymore. The Fed is now in this really delicate situation where China cut rates last week. We have an FOMC meeting, the Open Markets Committee that sets rates, on Wednesday, I think, of this coming week. What is he supposed to do? The risk is to a recession, because if we overcorrect,
yes,
and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. And right now we have to decide, because if we overcorrect, we're going to plunge the United States economy into a recession.
There's a lot of data here, and obviously this is when this data is always in the rearview mirror. So obviously we're talking about Q1. It takes a while to collect this data, and there's a lot of different factors going on at the same time. Obviously COVID and obviously supply chains. Consumer spending rose at a 2.7% annual rate in Q1, a slight acceleration from Q4. There was also a 9.2% rise in business spending. So we have a lot of spending going on. Who knows if that is spending that actually occurred in the previous quarters, and because of supply chains, like people's cars are being delivered or people's machines and manufacturing equipment is being delivered now.
We had negative GDP in Q1 for a whole host of reasons that can effectively be summarized by the fact that we are still trying to restart an economy at the tail end of a pandemic, and we're doing it in fits and starts. And so we have these small bursts of incredible GDP, which we had last year, and then contractions in the economy.
Right.
The thing that's always been true about the United States is that we are a consumer-driven economic engine, which means that as long as people feel confident and they're buying things, the economy tends to do well, and we tend to move forward as a society. When consumer confidence ebbs and people contract their spending, we are in a world of hurt. The last couple of years, we've had a lot of consumer savings, right? We've had a lot of money that's been pent up in the system, whether it's stimulus checks or, loan forgiveness, or all of this stuff has allowed people to feel much richer. And as a result, they've started to spend in dribs and drabs. The problem now is that because prices are so high, all of those savings have largely been depleted. I just sent you guys a text in the group chat of what consumer spending looks like, in consumer savings rather. And it tells a really, really scary story, which is that the savings boom is largely over. Personal savings rate fell to 6.2% in March, the lowest since 2013. And so what does that mean? Well, it means that the setup is there for us to sort of really contract what we are able to spend as a society. So I think now the odds even push further in this direction, that we could have more quarters of negative GDP. And all of a sudden, we're back to what we talked about before, which is a 2019-like scenario where the government, or the Fed specifically, races forward to tackle inflation. And in 2018 and 19, it turned out to be a head fake. And by the way, in 2019, the stock market ended up more than 30%, up 32% or something like that. Crazy numbers. Here, and by the way, back then in 2019, China turned over. It looked like it was going to be a fast-moving economic recovery for China, and instead they sort of slowed down. We have the same thing here. We have a quarter of negative GDP. We have China in lockdowns. We have every company that's in the manufacturing supply chain ecosystem telling the world that we don't really know what this is going to look like. Intel today actually said there's going to be shortages in chips through 2024. So I think I think it could be a very difficult path ahead for the Fed. How do you raise rates 400 basis points into a slowing economy? You could raise basis points 75, 75 bips, maybe 100 bips, but it gives them very little freedom to operate without really tanking the economy.
There's also another point to highlight here, which is in some of this data that was released, there was a strong indication that there are real issues right now with inventories. I don't know if you guys have tried to buy an appliance or a car lately, or a piece of furniture, but like
I tried in the Q4 to buy a car and it was absurd.
I mean, right now there's like 1 year delays to get a friggin' couch. I mean, like everything in the global supply chain, somewhat related to the kind of big inflationary pressure that hit us at the end of last year, and then everyone placed orders. All the factories kind of had to produce a lot. They all couldn't keep up, through to what's going on in China right now, where there's lockdowns and factories are shut down. I have several businesses in the hardware space that are actively searching and frantically trying to find components, suppliers, specific parts, even basic raw materials like aluminum are very hard to get a hold of. And so there's also a very challenging inventory and supply chain problem. When that happens, I can't actually wire money and buy aluminum because I'm waiting for aluminum to show up. I can't wire and buy the microchips I want. I can't wire money to my car dealership and buy money. So that doesn't get credited on the GDP counter because those sales didn't close that quarter. And as we saw with Amazon recently and others, and Apple just said that they're expecting, I think, close to a $10 billion hit this quarter because of supply chain issues. A lot of folks want to spend. The spending interest is there. The capital flows are there. It's just that the supply chain is clogged up and we're so dependent on getting atoms and molecules moved around, and they're all kind of held up in different places, that folks simply can't get their purchases in. And so the revenue triggers don't get hit. And so the numbers don't look good from a growth perspective, but it doesn't necessarily mean that the demand isn't there. This is a significant inventory problem and supply chain problem that's driving a lot of this this adversity right now in the market, it seems.
And interestingly,
and by the way, that doesn't mean that we're not going to have a recession, because when I'm not able to spend money on Apple's spending less on their suppliers and they're spending less on their suppliers. So there is a trickling effect of capital flows, and the recessionary effect may be hit. But there is capital and there is demand for consumption. It's just that we're really clogged up right now.
Well, and the consumer confidence index has been on a bit of a roller coaster. We were at 130 before the pandemic. For the year of the pandemic, we were down in the high 80s, 87, 88, 89. We rocketed back up. In 2021, people started to feel like, oh, we've got these vaccines, things are going to go back to normal, rocket back up to 128. And it's been a slow tick down to where we're now at 107. And so I think consumers don't know what to think. They don't know if inflation is transitory. They don't know if gas is going to be $7 or $4. They don't know if they should spend on a big vacation or not. And so this, I think, in terms of people's planning, I don't know if people can plan how their own personal budgets, right? And I think that's on the confidence thing, to Chamath's point. We need to have a predictable economy, and it can't be this schizophrenic, to use a term. Sacks, what do you think about what we're seeing here in terms of we're obviously either in a recession or dancing around it. We're basically on the edge of the cliff right now, I think is probably the most accurate.
I tweeted in February, hey, anyone notice that we've just entered a recession? And I got dunked on by all the professional economists and, all these people. But
the experts?
The experts. Yes, exactly.
Correct.
And now it's like the data just came out, negative 1.5% economic growth in Q1. So what I wrote at the time was exactly right. And, I don't know how the Fed threads this needle. I mean, we've got a slowing economy with negative GDP growth. You've got inflation is still rampant. It's not I don't think it's going to be as high as last year just because we're lapping a much bigger number from last year. So on a year over year basis, the comps are you start at a higher price level, but inflation's still there. So, I don't know what you do about that. It's a really tough situation. And when you have this kind of wealth destruction in the stock market, I mean, and there was a good tweet that Chamath, you shared. We should put it up on the screen. I mean, so much like wealth has been destroyed. You don't necessarily see it if you just look at the big cap indices, but you look at all the engines of sort of growth and prosperity, the small caps, the recent IPOs, the growth stocks, they've been absolutely hammered. It really hasn't been this bad since the dot-com crash of 2000, and not just the April period, but all the way in October where it kept going. And then the 2008
Recession.
The 2008 real estate crash. So we're already top 3 worst situations for growth stocks in the last 20 years. And when you have that kind of wealth destruction, it eventually trickles down into the economy because people just feel, companies start cutting budgets, people have less money, the spending goes down. That
dynamic that we're referring to in this tweet, in that image, is called dispersion, which means, people may be confused when you hear, why are all these stocks down so much, but the indices are not down as much? And it's exactly for the reason that David just said, which is that underneath the surface, the mega cap techs consume so much of the market cap of these indices. So, the Googles,
Apple,
the Microsofts, the Apples, and the Teslas. Those 4 just clog up an enormous percentage. I think it's approaching 40% of these indices. And so underneath the surface, you have dispersion, which means you have these tale of 2 kinds of stocks. You have these 4 big mega caps, and then you have everybody else. And the mega caps are generating so much cash that they're just basically keeping the market afloat. So at this point, maybe there's a small silver lining, and that silver lining is that to be bearish right now is effectively not being bearish these growth stocks, because as we said, they've been just decimated. At this point, to be bearish the indices means very specifically to be bearish those 4 names and only those 4 names. And so that may actually mean that the market has effectively crashed already.
Yeah, but by the way, I'm not necessarily bearish on growth stocks from here because, like you said, they've already been beat up so badly. The stock market's usually a leading indicator. What I'm a bearish about is just the state of the economy, because the stock market's trades down on expectations. So it was already trading down months ahead of the slowdown in the real economy. So
the market knew in December. The market knew in November that the recession was coming.
Around November 6th of last year.
Yeah.
And
they knew it was coming. Yeah.
The market knew when we talked about the sales that Bezos and Musk did, when we sold equities, we were saying you can't keep all of your money on the table all the time unless you have the durational wherewithal, meaning you're just not time bounded and you can just be there forever. And not everybody's in that position.
An endowment could be in that position, but individuals with...
No, an endowment is not, because they have to create distributions every year, right?
I'm talking about the mega endowments where they, Ford or Harvard may not need to do this, but yeah, smaller ones might actually be operating. Memorial Sloan Kettering might actually be operating their budget from it.
Yeah, but just to go back to David's point, it's a really difficult spot. What is the Fed supposed to do? So they're probably going to tighten 50 basis points in May. That's relatively well expected. We'll be able to digest that reasonably well. But what did they say, to David's point? If they all of a sudden go on a crazy program of quantitative tightening, right? And what is that again? That's when, they were printing,
money,
billions and billions of dollars, going into the market, buying securities and giving people the money, right? That's called quantitative easing. Now we're doing the opposite, right? Where they're selling and they want the money back. Now, the problem is what that does is that removes liquidity from the market. And when you remove liquidity from a market, you actually make it a little bit more fragile, a little bit more precarious, a little bit more price sensitive. And so it puts us in a very tough situation when the economy is slowing, when these guys may be raising rates, and then at the same time removing money from the system. It may be a lot for all of us to handle. And so I think that they're under a really difficult set of decisions.
There is a business cycle, and there are always recessions periodically every 7 to 10 years. But they have really magnified this because you had the Fed for years maintain interest rates really too low and doing quantitative easing during a boom. And then the federal government was printing trillions and trillions of dollars, and they didn't stop. It was one thing to do it during that sort of COVID recession, but then last year they printed that last $2 trillion, and that's what set off this wave of inflation. So, when I was like in school learning about economics and they would tell us that all these government programs and actions are like automatic stabilizers or what have you, like the government helps balance out the business cycle. No, the government like magnifies the business cycle. They've made this so much worse.
Well, they're putting their hand on the steering wheel, right? It's like, let the economy drive, let the free market do this. And if you start, you might oversteer into
the federal government is great at setting incentives, right? And creating like tax credit programs and incentives for private enterprise to invest money. But when they act as a direct market participant and start to actually direct capital flows and make decisions about how the capital market should work, it never ends well. Because this